I want you to start off today by just closing your eyes for a second.
Okay.
Just try to visualize a totally unfathomable amount of money. I mean, I am talking about $136.5 billion.
Yeah, it's a number so large it almost loses its meaning when you just say it out loud like that. You start thinking about, the GDP of small nations.
Right, exactly.
Or like the entire market capitalization of major tech companies.
Which is exactly why we need to anchor it to reality today. Because that number, $136.5 billion, it is not a GDP.
Right.
That is the actual record-breaking backlog that General Dynamics reported in the second quarter of 2026.
It's just massive.
Just think about that for a second. We're talking about a literal line of customers with contracts in hand, waiting to buy $136.5 billion worth of, private jets, nuclear submarines, armored vehicles, cybersecurity systems.
And this is where the raw transcript of an earnings call becomes just an absolute goldmine for us.
Oh, totally.
Because you have the executive team, right? The people who are deeply embedded in the operational reality of building these massive machines, and they are squaring off against Wall Street analysts who are, they're solely focused on the financial metrics.
Right. The analysts just want the margins.
Exactly. And the friction between those two viewpoints, the executives building the hardware and the analysts demanding the margins, it often reveals insights you never get that from a polished corporate press release.
Never. And as someone who, spends all day looking at tickers and trying to figure out what's actionable for retail investors, I've got the Q2 2026 transcript right here in front of me.
Let's get into it.
You're spot on about that friction. For this deep dive, we're going to tear into exactly how they beat Wall Street's expectations, the wildly different stories behind their four main business segments, and some honestly pretty entertaining sparring matches with those analysts.
Yeah, there were some great moments in the Q&A.
So good. But let's look at the baseline numbers first, the headline figures.
The top line, yeah.
Revenue hit $14.1 billion, which is an 8.1% increase year over year.
Solid.
Earnings per share, the EPS, hit $4.24, beating the consensus by 28 cents.
Right.
And their operating margin bumped up 40 basis points to 10.4%. So what's your take on that initial snapshot?
I mean, those are incredibly solid figures. But if you just stop at the revenue and the earnings per share, you are entirely missing the most important mechanism of this whole quarter.
So.
Because accounting profit is, it's just math on a spreadsheet.
Right.
To really understand the sheer horsepower of this quarter, you have to look past the top line numbers and go straight to the cash flow.
The actual cash in the bank.
Exactly. In this report, the cash flow is the undeniable star of the show.
Yeah, I'm looking at the transcript now, and it says they generated $1.9 billion of operating cash flow just in this quarter alone.
Just in Q2, yeah.
And combined with Q1, that's over $4 billion in the first half of the year. But here's where I need you to help me and the listener wrap our heads around the math of it all.
Sure. What's the hang up?
Well, the executives kept bragging about this cash conversion rate that exceeded 150% in the first half of 2026.
Yes. The 150%.
Wait, hold on though. 150%. How do you turn $1 of profit into $1.50 in the bank? Like, are they selling off the furniture in the boardroom? What's going on there?
It sounds totally impossible until you look at the actual mechanics of corporate accounting.
Okay, walk me through it.
So in the business world, you can have a very profitable quarter on paper. Right?
Yeah, your EPS looks great.
Exactly.
Yeah.
But if your customers haven't actually paid their invoices yet, or, if all your cash is tied up in raw steel sitting in a warehouse somewhere.
You don't actually have the cash.
Right. Your cash conversion rate is going to be terrible. Cash conversion basically measures how efficiently a company turns its on-paper accounting profits into actual liquid cash that it can spend or invest.
Okay, so just to clarify, a 100% cash conversion rate would mean for every dollar of profit you claim on the spreadsheet, you actually clear one real dollar into the corporate bank account.
Yes, exactly. Now, to hit 150%, you have to run your operations with just ruthless efficiency.
So no selling the boardroom table.
No. You don't get there by selling off furniture. You get there by actively shrinking what's called your operating working capital.
Operating working capital.
Right. And in this quarter alone, General Dynamics had their working capital go down by over $1 billion.
Break that down for me, though. How does shrinking working capital create $1 billion in cash? I feel like a lot of retail investors get tripped up on this concept.
Yeah, it's a bit dense. Think of working capital as the money that's trapped inside the machine.
Trapped in the machine. Okay.
It's the inventory sitting on the factory floor, waiting to be billed. And it's the bills your customers haven't paid you yet.
Got it.
So if you suddenly get much better at collecting on your outstanding invoices, meaning customers actually, finally wire you the money they owe you.
So money comes in.
Yes.
Yeah.
And at the exact same time, you burn through the inventory you've been hoarding without having to go buy more.
Oh, I see.
That trapped money turns into liquid cash.
That makes total sense.
They're pulling cash out of the balance sheet faster than their raw net income would suggest.
Yeah.
I mean, they are generating an absolute river of liquidity right now.
A river of liquidity. I love that phrasing. But I'm trying to visualize this river of cash, and reading through the transcript, I had a massive question about a really specific choice they made with it.
The pension move.
Yes, the pension move. They took $500 million, $500 million in liquid cash, and just dumped it straight into their pension plans.
Yeah, it caught a lot of analysts off guard too.
Right. I mean, in a quarter of massive growth and insane demand, why lock up $500 million in a pension fund?
It seems weird, right?
Like, why not pour that into research and development? Or, I don't know, buy out a competitor? Or just issue a massive special dividend to the shareholders? As an investor, that's what you want to see, right?
It totally seems counterintuitive to lock up cash during a boom, but it actually speaks to a highly specific financial strategy called de-risking.
De-risking.
Yeah. You have to view this not as an aggressive growth move, but as like the ultimate defensive financial maneuver. And it's a move they can only make because they are operating from a position of profound strength right now.
Okay, but how is locking up $500 million a flex of strength? Like, explain the defense here.
Sure. You have to conceptualize a corporate pension plan as a giant, a completely separate investment portfolio that the company is legally obligated to maintain for its retirees.
Right. It's a promise they made to their workforce.
Exactly. When the stock market is booming, the pension plan's investments grow organically. The plan becomes fully funded, meaning it theoretically has enough assets to pay out all those future obligations.
And the transcript specifically mentioned that market returns have been very favorable over the last few years, which makes total sense. We've had a bull run.
Right. So their pension plans are currently in great shape. But markets are inherently volatile, right?
Always.
If the broader market crashes tomorrow, the value of that pension portfolio plummets, and suddenly the plan is underfunded.
Oh, I see where this is going.
When that happens, the company is legally forced to divert cash away from its core business to plug the hole in the pension fund.
Wow.
And historically, market crashes happen at the exact moment a company's core business is also struggling.
So it's a double whammy. It's like having to fix a severely leaky roof in the middle of a hurricane.
That is the perfect way to look at it.
You are suddenly forced to spend money you don't have at literally the worst possible time.
Exactly. So by taking this $500 million in cash right now and overfunding or fully securing the pension, they are effectively building a fortress around it.
They're fixing the roof while the sun is shining.
Yes. They are de-risking the entire balance sheet. They're eliminating the future volatility of that pension obligation.
That's smart.
They are signaling to Wall Street, look, we are generating so much cash right now, we are going to permanently solve this future liability so it can never suddenly drain our resources in a downturn.
It's like paying off the entirety of a 30-year mortgage just because you got a massive bonus at work.
Right, exactly.
Like, you technically don't have to do it, but once you do, you never have to worry about that monthly payment again, no matter what happens to the broader economy.
That is exactly the psychology at play here. It's a highly conservative, highly responsible move that only a company with excess cash can afford to execute.
Okay, so the macro financial picture of General Dynamics is this story of hyper-efficient cash generation and defensive, responsible balance sheet management.
Which Wall Street loves.
But while the accountants are playing defense, the company's most glamorous segment is out there playing pure offense. Let's shift gears and talk about the skies. The aerospace segment.
Gulfstream.
Yeah, primarily Gulfstream and jet aviation. They're having a massive moment right now.
The aerospace numbers in this quarter are just incredibly robust. I mean, we are looking at $3.5 billion in revenue, which is up 15.1% year over year.
Huge jump.
Operating margins hit 14.5%, which is a 130 basis point improvement, and they delivered 41 aircraft in the quarter.
Which actually beat their own internal plan by 3 jets, right?
Yep, 3 more than they planned for.
And the demand isn't slowing down at all. Their book-to-bill ratio was an incredibly strong 1.5 times.
That's the real standout metric.
So, for the listener who might not live and breathe manufacturing metrics every day, book-to-bill is going to come up a lot in this deep dive. Let's define it.
Yeah, it is the crucial metric for understanding future health. The book-to-bill ratio simply compares the value of the new orders coming in the bookings against the value of the products currently being shipped out and billed to customers.
So if you have a ratio of 1, you are basically treading water. You are taking in exactly as many orders as you are shipping out.
Yes. A ratio below 1 means your backlog is shrinking. Right. You're fulfilling past orders faster than you are finding new buyers.
Which is bad news.
Usually, yeah. But a ratio of 1.5, that means for every $1 of private jets they delivered and billed in the quarter, they took in $1.50 in brand new orders.
Wow. The line out the door is getting 50% longer every time they let someone into the club.
That's a great way to put it. The demand is vastly outstripping their current production capacity. And, management spent a lot of time on the call explaining what is actually driving this demand.
Yeah, they kept using this specific phrase.
It's the rollout of what they call their new wholesome portfolio of aircraft.
Right, wholesome portfolio, which spans from the G400 up to the ultra-long-range G800.
Exactly.
I noticed that phrasing. It tells me they aren't just selling one flagship plane anymore. They've essentially built an entire ecosystem of jets.
And this is a vital strategy in modern aerospace. Gulfstream has engineered a family of aircraft that share, common design languages, avionics, components.
Wow. So the pilots can switch between them easily?
Yes, and the mechanics know how to service all of them. But they cater to wildly different mission profiles. You have the massive, large cabin jets designed to fly nonstop from, New York to Tokyo.
Right.
And then you have slightly smaller, more agile jets for regional cross-country hops.
And the transcript highlighted this other concept, the learning curve in manufacturing these new models. I found this totally fascinating because it perfectly explains why their profit margins are expanding so rapidly right now.
Oh yeah, the learning curve is like a fundamental law of physics in aerospace manufacturing.
Tell me about it.
So when a company builds the very first jet of a new model, it takes an enormous amount of time, labor, and problem solving.
Because it's literally the first time they've ever put it together.
Exactly.
Wow.
The engineers and mechanics are essentially figuring out the assembler sequence in real time. But as you build the 10th, the 20th, the 40th jet, the assembly line gets smarter.
It's like if you've ever built a piece of IKEA furniture, you know exactly what this is.
Yes.
Right, like the first chair you build takes an hour, you put a piece on backwards, you drop the little hex wrench a dozen times.
You're sweating.
Yeah. But by the time you build the 4th chair, it takes you 10 minutes flat. Now, just apply that exact same human learning curve to a $70 million aircraft assembly line. That's where Gulfstream is finding millions of dollars in extra profit.
That is a brilliant analogy. The work has become more efficient, the supply chain synchronizes, the software integration just becomes routine.
So the costs go down.
Right. The internal cost to build the airplane drops significantly, but the price you charge the end customer stays exactly the same.
Or even goes up.
Exactly. Or even increases due to inflation and high demand. So the margin naturally expands just through the simple repetition of building the same complex machine over and over. Management explicitly noted they are coming down the learning curve across all these new aircraft types, which is exactly why that operating margin jumped to 14.5%.
They did flag one strategic hurdle on the horizon, though. There is a scheduled production break coming up that caught my eye.
Yeah, the G280 transition.
Right. The G280 line is scheduled to end in the 2nd quarter of next year, but the new model filling that mid-size slot, the G300, isn't slated for its entry into service until late 2027 or maybe early 2028.
Which requires very careful logistical planning.
Because you have a gap.
Exactly. You were looking at a physical gap on the factory floor, a period where overhead costs for that specific facility continue, but finished products aren't rolling out the door to absorb those costs.
So that's a margin headwind.
It could be. However, management seems highly confident that the sheer volume and the high margins of their larger cabin jets will easily absorb any overhead pressures during that specific transition period.
Okay, we need to talk about the most entertaining part of this aerospace discussion.
Oh, the Q&A.
Yes. During the Q&A session, an analyst brought up a question about pricing power. He directly compared Gulfstream's premium jets to, and I quote, handbags and champagne.
I literally laughed out loud when I read that part of the transcript.
Right. He was making the point that the luxury goods market routinely sees profit margins north of 20%. And he was essentially pushing management to see if Gulfstream could hike their prices into that, like, ultra luxury margin territory.
And the management's reaction to that comparison was swift, pointed, and highly revealing.
The executive completely rejected the word luxury. He wouldn't even entertain it. I love this exchange because it highlights such a fundamental disconnect in how these machines are perceived by Wall Street versus the people building them. The analyst looks at a $70 million private jet and sees a status symbol. He sees a yacht for the sky. He sees a Birkin bag.
A flying Birkin bag, yeah.
But management looks at that exact same jet and sees a piece of critical corporate infrastructure.
They are telling Wall Street in no uncertain terms, we do not price our airplanes based on vanity.
Exactly. I was thinking about an analogy for this. Management views these jets the same way a massive tech company views a high-speed server rack.
Okay, I like that.
You know, like you do not buy a top-of-the-line, multi-million-dollar server rack to show off to your friends at a dinner party. You buy it because your enterprise business literally cannot function without that level of speed, security, and reliability.
It's purely functional.
Yes. These Gulfstream jets are high-speed server racks for executives. They are essential business tools for Fortune 500 companies who are intensely focused on the safety and the efficacy of moving their top decision makers around the globe instantly.
The utility is the selling point, not the champagne flutes in the cabin. The executives flying on these planes are doing so because they need to be in like 3 different time zones in 3 days to close acquisitions, inspect supply chains, and meet with regulators.
Time is money.
Right. And the manufacturer prices their aircraft based on the highly specific mission requirements of the buyers.
Like what?
Things like the aerodynamic range, the Mach speed, the payload capacity, the dispatch reliability.
It is a totally calculated branding stance. They are rejecting the volatility and the perceived frivolousness of the luxury label, right? They're anchoring their product as an indispensable utility for global commerce.
And judging by that 1.5 book-to-bill ratio, that strategy is resonating perfectly with the people actually writing the checks.
Okay, so if the aerospace segment is driven by corporate efficiency and the velocity of global commerce, we have to recognize that the next segment is driven by a metric that is, frankly, significantly darker.
Yeah. Geopolitics.
Yeah. If corporate executives are buying time with those jets, international allies are buying survival with our next segment. Let's look at combat systems, which is acting as a very loud, very real geopolitical barometer right now.
In combat systems, we are dealing with armored vehicles, munitions, artillery, basically the blunt instruments of hard power.
Right.
The core numbers here are fascinating. Combat systems pulled in $2.3 billion in revenue. Now, overall, that revenue growth was pretty marginal compared to last year. It barely moved.
But the orders?
The orders were staggering. The segment hit a 2.1 times book-to-bill ratio.
Let me just pause on that, 2.1. For every dollar of tanks or ammunition they delivered, they took in $2.10 in new orders.
Just massive demand.
That is an explosive level of demand. But where is all this demand coming from? Because according to the transcript, it's not necessarily the legacy U.S. land forces driving this spike.
That is the critical nuance here. The demand spike is not a broad, even wave across all their defense products. It is highly concentrated, and it is primarily being driven by international allies reacting to immediate real-world threats.
Meaning Europe.
Exactly. The transcript highlighted 2 specific drivers. First, European Land Systems, or ELS, is experiencing double-digit growth.
Wow.
And second, Ordnance and Tactical Systems, OTS, is seeing massive spikes in munitions output. They specifically mention 155mm artillery shells and missile components.
Which tells you exactly what kind of conflict is currently shaping global procurement.
Ukraine.
Yeah. The war in Ukraine has fundamentally altered the inventory strategies of European nations. I mean, they are waking up to the reality that high-intensity conventional land warfare consumes artillery and combat support vehicles at a rate that peacetime supply chains simply cannot sustain.
You are looking at the realities of artillery consumption. Just forging the steel, filling the explosives, machining the fuses of the bottleneck for 155mm shells is immense.
And it takes time to build that capacity.
It does. European Land Systems is booming because allies are rapidly expanding their armored vehicle fleets, and the munitions division is working overtime to restock depleted artillery reserves across the entire continent.
But I'm looking at these land systems numbers in the transcript, and I feel like I'm taking crazy pills.
What do you mean?
Well, you just said they have a 2.1 book-to-bill ratio, and European allies are buying everything they can get their hands on, right?
Right.
But right here in the text, the revenue for legacy U.S. land systems actually declined this quarter.
Yep.
So how are they simultaneously booming and shrinking? How does a defense company report marginal revenue growth and a declining legacy division while claiming the group overall is thriving? It feels contradictory.
It does seem that way, but this raises an important question about the life cycle of military procurement.
Yeah.
What we are seeing here is what the executives refer to as a transition period.
Okay, what does that mean in practice? What is transitioning?
The U.S. military is currently in the process of recapitalizing its armor. They are moving away from older legacy platforms and designing the next generation of combat vehicles.
Oh, like the Abrams tank replacements?
Right. Think of the transition to things like the Abrams X or the replacements for the Stryker vehicles. During this design, prototyping, and testing phase, full-rate production of the old vehicles winds down.
Because they don't want to buy the old stuff anymore.
Exactly. But the new vehicles aren't ready to be mass-produced yet. That creates a temporary revenue valley for the U.S. Land Systems Division.
Ah, so they are caught in the waiting room between the old blueprints and the new blueprints.
Precisely.
All right.
But the immediate global threat environment doesn't care about the U.S. transition timeline.
Europe needs stuff today.
European allies and international partners need hardware today. So the massive spike in munitions and international vehicle orders, like they mentioned the new Armored Combat Support Vehicles contract they just signed with the Canadian Armed Forces. Yeah. That international demand is acting as a massive financial bridge. It is carrying the entire combat systems segment over this temporary U.S. transition valley.
They are bridging the gap with international demand while the U.S. gets its next generation designs finalized. That actually makes total sense.
Furthermore, the transcript revealed another layer to their strategy that often goes unnoticed by, casual retail investors. General Dynamics isn't just selling fully assembled tanks. They are a crucial subcontractor supplying vital components to other major prime contractors.
Oh, I caught that during the Q&A. An analyst asked about missile framework agreements.
Yeah, the missile components.
General Dynamics is supplying actuators, motor cases, and solid rocket motors for missiles that are technically built by their competitors. Like they're selling the parts to the other guys.
It is a brilliant, highly insulated strategic position as the Department of Defense pushes for aggressive dual sourcing.
Meaning they mandate having multiple companies capable of building critical components.
Yes, so they aren't reliant on a single point of failure. General Dynamics steps in to provide the underlying guts of these weapon systems. They don't have to be the prime contractor on a new missile program to profit immensely from the demand for that missile.
Because they're building the engine.
They are manufacturing the complex physics of the solid rocket motors.
It's the old adage about selling shovels during a gold rush, but in this case, they are selling the solid rocket motors during a precision missile boom.
Exactly.
So OTS is working overtime, turning out 155 millimeter shells for immediate land wars. But those are highly expendable short-term munitions.
Right.
When you look at how General Dynamics is allocating their massive cash pile for the next 20 years, they aren't looking at land. They are looking underwater.
The submarines.
Yes. Let's transition to Section 4, Marine Systems and accelerating the fleet, because this is where the real long-term capital is going.
The Marine Systems segment, which is their shipbuilding arm, is operating on a totally different timeline than the rest of the company. It grew by an impressive 10.4%, with operating margins improving to 17.5%.
The growth was largely driven by the Columbia and Virginia-class submarine programs, which we expect, but there was a surprising detail in the transcript. The surface shipbuilders, NASSCO and Bath Iron Works actually outpaced Electric Boat in percentage growth this quarter.
Which is a testament to the operational turnaround happening at those surface yards.
Shipbuilding is tough.
It's notoriously difficult. It is heavy industry at its absolute most complex, involving tens of thousands of workers coordinating millions of individual parts. But they highlighted some major operational wins in the call.
The illustrative details here are fantastic. Bath Iron Works delivered a DDG-51 destroyer almost 3 months ahead of schedule.
That's huge.
Delivering a guided missile destroyer 3 months early seems like an incredible feat of project management. I mean, how does that even happen?
It speaks to the excellent sea trial performance that was mentioned in the call.
Sea trials.
Yeah. Sea trials are the brutal testing phase where the Navy takes the newly built ship out and basically tries to break it.
To make sure it works in combat.
Right. If systems fail, the ship goes back to the yard for months of costly rework. Delivering 3 months early means they built it right the first time, tested it, and it worked flawlessly, allowing the Navy to take possession immediately.
And on the submarine front, which is handled by their electric boat division, the hours earned are up 37% in the first half of the year. Let's clarify that term for the listener because hours earned sounds like a payroll metric, like the guys just worked more overtime.
Yeah, it's not that. Hours earned is a key metric in defense accounting, and it doesn't just mean people are clocking in and standing around.
Okay.
It means actual, quantifiable, physical progress is being made on the construction of the submarine according to the master schedule. A 37% jump means they are putting the physical puzzle pieces of the submarine together significantly faster than they were a year ago.
Okay, let me play devil's advocate here, because to make this 37% jump happen, General Dynamics is spending an absolute fortune.
They are.
The CFO explicitly stated they are pouring 3.5% to 4% of their total company sales into capital expenditures, or CapEx, and it is mostly weighted toward the shipyards in the back half of the year.
It's a massive investment.
Why? If the marine segment is already hitting the law of large numbers in terms of revenue growth, why is so much internal cash being poured into the physical concrete and steel of these shipyards? As an investor, wouldn't you want them to ease off the spending and take the profit?
This is perhaps the most important strategic point in the entire earnings call.
Okay.
If you peel back the layers, this is about national security on a multi-decade timeline. You have to understand that building a nuclear submarine is not like building a car. You don't just speed up the assembly line by adding a few robots.
Yeah.
A nuclear submarine is arguably the most complex machine human beings build. It is essentially a submerged city wrapped in acoustic stealth technology, surrounding a miniaturized nuclear reactor designed to operate in some of the most intense pressure environments on Earth.
Right. Like we said earlier, it's a spaceship that goes underwater.
Exactly. And the strategic goal of the United States Navy, the direct mandate given to General Dynamics, is to build 2 Virginia-class attack submarines and 1 Columbia-class ballistic missile submarine per year by the early 2030s.
2 Virginias and a Columbia every single year.
Yes. And the brutal reality is that the physical infrastructure of the American shipbuilding industrial base as it stands today is not large enough or modernized enough to hit that cadence.
Oh.
The only way to reach that goal is to aggressively expand physical capacity.
So they literally need bigger yards.
Yes. That means dredging new dry docks, building massive new crane infrastructure, constructing new manufacturing facilities for hull sections, and training tens of thousands of new, highly specialized welders and nuclear engineers.
So that's where the CapEx is going. They aren't just building ships. They are building the capacity to build ships faster.
They are unkinking the physical bottlenecks. And it's not just internal capacity as electric boat. It's the entire external supply chain. The transcript noted a 65% increase in sequence-critical material receipts.
Let's unpack that term, sequence-critical material.
When you build a submarine, you build it in massive cylindrical modules or sections that are eventually welded together.
Like slices of a tube.
Right. But there are certain components, heavy machinery, specialized pumps, the reactor components, that have to be installed at a very specific time in the sequence.
Because of the shape.
Exactly. If that specialized pump is late arriving from a supplier in Ohio, the entire module halts. You cannot just skip it, weld the hull shut, and install the giant pump later. It is sequence critical.
Because once the steel is welded, you can't get the huge parts inside.
I see. Exactly. Thousands of workers end up just standing around waiting for a truck.
That sounds incredibly inefficient.
It is. So a 65% increase in receiving those critical parts on time means the external supply chain, the thousands of smaller Tier 2 and Tier 3 companies feeding parts to electric boat, is finally stabilizing after the chaos of the pandemic years.
But the shipyards are still holding their breath for one specific bureaucratic milestone. The analysts brought up the pending Block 6 Virginia-class contracts multiple times.
Yes, there is immense anticipation around Block 6. These are long-term, multi-ship procurement contracts. The industrial base urgently needs these contracts signed, not just for the revenue, but for the legal stability.
I'm trying to put myself in the shoes of a smaller supplier. Why does a specific signed contract matter so much if everyone in the industry already knows the Navy wants the subs eventually?
Imagine you own a small, specialized manufacturing firm making high-pressure valves for the submarine.
Okay.
You cannot go to a commercial bank and get a massive loan to expand your factory and hire 50 new machinists based on a verbal promise from a Navy admiral in a press briefing.
Ah, the bank wants paper.
Right. You need the signed Block 6 contract to flow down through General Dynamics to your company, so you have the ironclad legal certainty required to invest in your own workforce and capacity.
That makes total sense.
Getting Block 6 signed is the starting gun for the entire American supply chain to staff up for the next decade.
Okay, we've got the physical steel covered, air, land, and sea. But none of that steel works without the digital nervous system coordinating it all.
The cyber side.
Yeah. Let's move to Section 5, technologies, agile growth, and the AI question. This was a really surprising part of the call for me.
The technology segment, which includes mission systems and General Dynamics Information Technology, or GDIT, pulled in $3.6 billion in revenue.
And a standout stat here. The international portfolios within mission systems are up 35% since 2020.
Which perfectly mirrors the international demand we saw in combat systems. Global allies are upgrading their secure communications, their cryptography, and their battlefield networks just as rapidly as they're buying 155mm shells.
Because they have to.
You cannot operate modern armor without modern networks.
But the domestic side of GDIT presents a really interesting challenge. The management team openly discussed navigating elongated procurement cycles with the U.S. government. Basically, the bureaucratic machinery is taking a really long time to make buying decisions.
Which is a traditional structural headache in defense contracting. The standard federal acquisition regulation process, the FER, can take years.
Years, just to buy software.
Oh, yeah. By the time the government issues a request for proposal, evaluates the bids, deals with protests from losing companies, and finally awards the contract, the technology they asked for might already be obsolete.
Wow. So how is GDIT actually winning and growing in an environment where the customer is that slow?
By utilizing an alternative pathway. The transcript highlighted GDIT's aggressive and highly successful use of OTAs, or other transaction authorities.
I want to focus on this because it's a term that gets thrown around in defense circles constantly, and it's super actionable for investors tracking government tech. Explain what an OTA is to someone outside the Washington Beltway. What are the actual mechanics of it?
An OTA is essentially an agile contracting mechanism created by Congress. It legally allows the Department of Defense to bypass the traditional, massive, slow-moving ARR procurement rules, specifically when they are buying commercial research, prototyping, or new technologies.
So it's the fast pass lane at the amusement park for tech.
It absolutely is. Yeah. If the military needs a new cybersecurity software prototype immediately to counter a new threat, they cannot wait 3 years for a traditional contract.
They'd be hacked by then.
Exactly.
Yeah.
So they use an OTA. They can rapidly test software, iterate, and deploy. And GDIT won more OTAs in the first half of 2026 than they did in all of 2025.
That's a huge jump.
They have positioned their workforce perfectly to catch these fast-moving, agile tech contracts.
They also mentioned that the current administration is shifting toward fixed-price contracting for services, and the GD management said they openly welcome it, which caught me off guard.
Why is that?
Well, this seems like a remarkably confident stance. And to understand why, you have to look at the difference between cost plus and fixed price.
Yeah, break that down.
So in traditional defense development, you use a cost plus contract. The government covers whatever you spend to develop the unknown technology, plus a guaranteed profit fee on top. It protects the company from massive losses if the engineering proves harder than expected.
Right, because you don't know how much it costs to invent something that doesn't exist yet.
Exactly. But in a fixed price contract, the government says, we will pay you exactly X dollars for this IT system. If it costs you more to build it or manage it, you eat the loss. The government doesn't bail you out.
The risk shifts entirely to the company.
Yes. However, if you can build it cheaper and more efficiently than you estimated, you keep all the extra profit.
So welcoming fixed-price contracting means GDIT is highly confident in their internal cost estimating and their operational efficiency.
Right.
They believe they can execute the IT work cheaply enough to actually widen their own profit margins. It is a massive gamble for an inefficient company, but a massive opportunity for a disciplined one.
And clearly, they think they are disciplined. But the most fascinating part of the technology discussion came from a question about artificial intelligence.
Oh, this was such a good question from the analyst.
It was an incredible question. An analyst posed a really insightful, almost existential question to the management team. He essentially asked, if AI models mature and create massive operational efficiencies, like automating code generation or streamlining massive IT help desks, will that actually shrink the total addressable market for a company like GDIT?
It's the big fear, right?
Yeah. Are they, by utilizing AI, basically coding themselves out of a job?
It is the ultimate paradox of efficiency in a service-based business. If you get paid by the government to manage a network, and AI allows you to manage that network with half the manpower, does your revenue inevitably get cut in half? It's a variation of the Jevons paradox.
So how did management respond to that fear? Because as an investor, you want to know if AI is going to destroy this revenue stream.
Management fundamentally rejected the premise that AI is a market shrinker. They view AI as a digital accelerator.
I want to spend some time on this because it's a profound shift in how we view automation. They aren't looking at AI as a tool to just do the same old jobs faster and cheaper.
Think about the historical analogy of the ATM. When the automated teller machine was introduced, everyone assumed human bank tellers would go extinct.
Of course.
Instead, because it became vastly cheaper to operate a branch, banks opened thousands of new branches, and the total number of bank tellers actually increased. The technology didn't shrink the market. It expanded the scope of what was possible.
Oh, that's fascinating. So apply that to defense cybersecurity.
GDIT is tightly integrating AI with their cybersecurity offerings.
Yeah.
The threat environment in cyber is growing exponentially, right? The sheer volume of network attacks from state and non-state actors is staggering.
It's a constant.
Human operators alone cannot monitor every endpoint. By deploying AI, GDIT isn't eliminating their own jobs. They're expanding their capabilities to secure and connect increasingly complex systems across hundreds of different government agencies simultaneously.
It's not about doing the existing work in less time. It's about being able to take on a vastly larger scope of work that was previously physically impossible for human beings to manage.
Right.
AI isn't shrinking the pie. It's allowing them to bake a much larger, infinitely more complex pie.
They're moving their workforce up the value chain. Instead of providing raw manpower to reset passwords, they're providing hyper-advanced AI-enabled security architectures.
So we have aerospace expanding margins on the learning curve. We have combat systems bridging the gap with international demand. We have marine systems unkinking the physical supply chain to build submarines. And we have technologies using agile OTAs and AI to expand their market.
A lot of momentum.
It is. How do you wrap a bow on all that momentum? Let's move to section 6, forward guidance and the art of the earnings call.
The executive team was, unsurprisingly, incredibly bullish. They raised their full year 2026 EPS guidance to $16.87.
Which is great news for investors.
Yep. They are projecting total company revenue of approximately $55.7 billion, maintaining a very healthy 10.5% operating margin.
But beyond the raw numbers, the psychology of this earnings call was fascinating to observe. An earnings call is essentially a theater of expectations.
It really is. You have Wall Street analysts probing for weaknesses, trying to model out the future to the exact decimal point, demanding certainty on every little detail.
Right.
And you have executives trying to control the narrative without legally boxing themselves in with forward-looking statements that could come back to haunt them later.
The executive team at General Dynamics put on an absolute masterclass in boundary setting here. My favorite exchange of the entire call was with the analyst Miles Walton, who asked about mergers and acquisitions, M&A.
Oh, that was classic.
He noted their massive cash pile and politely asked what properties or companies they might be looking to buy.
And the CEO's response was incredibly blunt. She literally said, "Nice try." This is something we always look at and something we never talk about.
Nice try. Just completely shutting the door in front of the entire financial world. No hints, no corporate speak about evaluating strategic synergies in the marketplace.
Right.
We don't talk about it. Next question.
And that wasn't the only instance of them laying down the law either. When another analyst tried to push them to forecast aerospace margins a couple of years out, asking if they would return to prior peak levels, management immediately cut them off.
They weren't having it.
They refused to give out year margin projections, explaining that the business model has fundamentally changed with the new wholesome portfolio of aircraft, making historical comparisons moot.
They also refused to guess the exact timing of the FAA's entry into service certification for the new G300 jet.
Right, the regulatory timing.
They pointed out that the federal regulators set the pace for safety certifications, not the manufacturer, and they weren't going to play guessing games with the FAA's timeline. So what does this aggressive boundary setting actually signal to the investors listening?
It is the ultimate flex of corporate confidence. When a company is struggling, or when they desperately need to convince Wall Street to believe in a turnaround story, executives will often over-explain.
They try to sell you on the dream.
Exactly. They will dangle hints about M&A to generate hype. They will paint rosy pictures of massive margins 5 years in the future just to keep investors happy today. They tap dance.
But when you are sitting on a $136.5 billion backlog...
When you have a backlog that massive, and you are generating over $4 billion in half-year cash, you do not need to tap dance.
You just point to the scoreboard.
You don't need to spin a story or overpromise on things outside your control. The silence, the strict boundaries, the blunt, nice try, all of it signals to Wall Street. Our numbers speak for themselves. We are focused on executing the massive amount of work we already have contracted, not playing forecasting games to temporarily bump the stock price.
It's a remarkably powerful posture. Okay, let's bring this deep dive to a close and summarize the incredible amount of ground we've covered today from this Q2 2026 snapshot. General Dynamics is a company that has successfully navigated the post-pandemic supply chain chaos. They have stabilized those external kinks, whether it's getting sequence-critical reactor components to a shipyard or avionics to a private jet assembly line.
And they are utilizing that newly stabilized supply chain to aggressively deliver on a historic, record-breaking backlog. They're effectively turning geopolitical tension in Europe and high-end corporate aviation demand into a highly efficient, massively profitable, cash-generating machine.
They are defensively de-risking their pensions from a position of strength. They are rejecting the luxury label for their jets by framing them as essential corporate utilities. They are bridging legacy U.S. armor transition gaps with international munitions panic buying. And they are pouring internal capital into their shipyards to rebuild the American submarine fleet capacity. It is a portrait of an industrial titan operating at peak capacity.
It is. Yeah. But it is always our job to look past the horizon of a good quarter and ask the difficult structural questions.
So I want to leave you, the listener, with a final, lingering, provocative thought to mull over on your own time. We've just spent an hour detailing how this massive industrial machine is currently perfectly tuned and calibrated for a heightened global threat environment. They are thriving in an era of massive, urgent defense budgets and international anxiety. The demand signals across combat and marine systems are all flashing red, indicating urgency and rearmament. But what happens if the global temperature suddenly drops? What if peace breaks out?
It is a vital caution. If the conflict in Ukraine is resolved diplomatically, if tensions in the Pacific cool down and defense budgets flatline, will the dual-use nature of their aerospace division selling those high-speed server racks to corporate executives be enough to balance a sudden, precipitous drop in demand for artillery shells and armored vehicles?
Or, conversely, are these long-term shipbuilding contracts and massive technological infrastructure upgrades so deeply locked in by the Department of Defense that they are essentially fail-proof? Does the sheer multi-decade timeline of building a nuclear submarine guarantee General Dynamics growth regardless of what the daily news cycle says?
It's a fascinating thing to consider.
Think about that the next time you see a headline about global defense spending, or the next time you try to wrap your mind around a wait list that is $136.5 billion long. It's not just a number on an earnings transcript. It is a mirror reflecting the exact anxieties, the physics, and the infrastructure of the world we live in right now.